Welcome back, everybody. So today we are going to be talking about the bond market and why the bond market is very, very, very important. Now, the executive summary is that the bond market basically sets the cost of capital globally, and typically the most liquid market is the United States, and that is why I focused on the US a hell of a lot, is because the US basically dictates monetary policy and fiscal policy globally. Now, when it comes to the bond markets, there is different types of bond markets in different types of jurisdictions. So you have the bond market in China, you also have the UK gilt market, what is basically just a fancy word of saying the UK bonds, Canadian, European, and they're all set in their own denominated currency. So you do have currency risk with the bond markets as well. So in the US, obviously the bonds are in the US dollar, and you have different types of duration. So the duration is typically 3 months, 6 months, 2 years, 10 years, 20 years, 30 years, etc. And obviously, as you probably imagine, you are normally rewarded to tie up your money for longer duration, meaning that you are going to get a higher level of return for tying up your money for longer periods of time. Now the reason why you have the yields start to spike on different types of duration is because people are forced to liquidate. Now, there's also other different types of reasons as well. So the reasons can be just people don't trust the US. They're losing faith in the United States dollar, in the bond market. People think that they can get better returns elsewhere. There's expectation from inflation. So people could be kind of demanding more return on tying up their money for different types of duration. And obviously you can see the yields start to tick up as a result. What that basically means is that the bond goes down and the yields go up. So they typically work inadvertently to each other. And normally what you see is that as bonds start to go up, you typically see the stock market or markets in general come down. So you have this inversion. And the reason why you have this inversion is because people typically see US Treasury bills or the bond market as a safe place to park your money. Now, obviously, we have different types of alternative places to store your money, such as gold, Bitcoin, or whatever. Now, what I've been talking about over the past couple of weeks and months is just in relation to the amount of financial stress in other countries outside of the United States. So these countries typically hold gold, US Treasuries, or just a mixture of different types of financial instruments. And when they are under financial stress, they are forced to liquidate whatever's the most liquid. And obviously, as you can probably imagine, the United States bond market is the most liquid market on the planet. And just another note as well, the bond market is significantly larger than the stock market. So the reason why it's very, very important is because of just the sheer size of it. And also, when you start to see yields spike aggressively very, very quickly, you typically have a lot of stress in countries, as well as margin calls, or whatever you kind of want to call it. And now let me just explain why the interest rates are very, very, very important. Is because, let's say you own a property, and I'm quite fortunate, to be honest, that I speak to a lot of lenders on a weekly basis, mortgage lenders in the UK, in Canada, in the US, and the US mortgage market is very, very different to different types of mortgage markets around the world. So in the UK, for example, when you take out a mortgage, you are typically locked into that rate for 2 years or 4 years or 5 years or whatever. And at the end of that term, you are forced to basically refinance your house at the current rate. So for example, let's say you buy a house at £500,000 on, let's say, a 1.5% interest rate, and you were paying, let's say, £1,500 a month, and now you are forced to refinance that house at 4.3% or 4.5% interest rates. That mortgage repayment every single month could be at like £3,500, £4,000 a month, depending on the loan to value of your property. And this is the reason why it's very, very, very important to understand the bond market and why interest rates matter so much, because it doesn't just affect mortgages, it also affects credit cards, it also affects car payments, well, car loan payments, if that kind of makes sense. So, and this is why I keep stressing that having interest rates this elevated for so long, you will typically start to see a significant amount of stress, because people are basically forced to liquidate their assets to basically pay off their liabilities. And I've been talking about this over the past couple of weeks and months just in relation to balance sheet impairments. And that is basically where you have assets what sit on a balance sheet. Them assets have gone down in value because there's not enough credit chasing, or there's not enough money chasing them assets. So let's say you might have $10 million worth of property, and then properties now are worth $7 million. Now, obviously, when you revalue them properties at 7 million, you could potentially break loan covenants, where then you are basically forced to liquidate the assets to basically pay back the loan, dependent on the covenants of the loan. So again, it can be a little bit tricky to kind of understand and assess all of this at once. But one thing, what I think is very, very interesting to actually do is look at how many mortgages are coming up for renewal on a quarterly basis. Just the amount of financial stress what these interest rates are going to put on the average person is going to be absolutely insane, especially when it comes to mortgages. I mean, like I was saying, in the UK, it's a very, very different market to the US, where the US, you typically lock into a mortgage rate for pretty much however long you want, right? And that's why a lot of people are not necessarily moving houses, because they have a very good mortgage rate. Whereas in the UK, you are forced to go onto a new rate every 2 years, or every 5 years, or 4 years, or whatever. So now this is basically what I'm getting at, is that as the bonds start to tick up, this has a knock-on effect on credit cards, on loan applicants, on mortgages, on absolutely everything. 5% is the base rate. So if you are going to get a credit card, or if you're going to get a mortgage or whatever, the interest rates on them mortgages are going to be a lot higher than 5%, because the bank needs to make money. And again, it's like, why would you put capital at risk when you can basically get 5% risk-free? And again, this is when you have these contractions. So you have obviously business cycles from boom and busts. So again, you have like a credit contraction. And this typically is when obviously the cost of borrowing or the cost of getting capital is very difficult to obtain. And this is the reason why people go out of business, is because the cost of servicing the debt is significantly high. Businesses what don't have a significant amount of debt are going to be just fine. But if you have a business what is severely, severely indebted, or what thrives on credit expansion, where you are constantly taking on leverage to basically grow the business, etc., etc. Now, any fluctuation on the interest payments is going to be absolutely catastrophic to your cash flow, to your profitability, and to basically everything else. So this is why I keep reiterating that the bond market is so important, because that basically sets the cost of capital, and everything else is obviously on top of that. So again, if you are somebody who has a significant amount of debt and you're on variable rates, I mean, it is a very, very difficult time for these individuals, for these businesses, because you are going to be feeling that contraction. And, you know, this is just a cycle of boom and bust, right? But again, I mean, a lot of people keep saying, well, again, the Fed can cut, the Fed can cut. The Fed can't just cut because of, again, like I keep explaining, they don't control the long end duration. The UK bond market at the moment is absolutely destroyed. It's not going to be looking good for anybody who's looking to remortgage in the next 6 months, unless obviously the yields start to come down. Now, again, how can you make the yields come down? Is by basically making your policies more attractive for investment. You want people to be coming to the UK rather than leaving the UK. Now, again, this is not a video on the UK, but there's a lot of structural problems in the UK from a policy perspective, from a social perspective, from basically absolutely everything. And this is what I'm kind of getting at, is like, these markets are so fragile that any changes in these interest rates have massive knock-on effects on businesses, on individuals, and absolutely everybody. So, and this is why I was saying in my previous video that I think it would be intentional why they would need to kind of bring the stock market down or scare the stock market to make people go back into US treasuries. Because if these rates keep ticking up even more, it is going to be very, very, very difficult for a lot of businesses around the world. Not necessarily just in the US, but the UK, in Europe, and yeah. And again, we can kind of debate, why are they currently doing this? Now, tying this back to the stock market, the reason why the stock market would typically go down as yields start to go up is because the cost of borrowing, the cost of capital is going to be significantly higher, meaning that it's going to impact company profits, company earnings, and obviously the stock price of that company. So, and that is typically why you see this inversion. As yields start to tick up, typically you see the stock market go down, but that has not necessarily happened in the past couple of weeks. So this is why it's a very difficult time, because a lot of bears are frustrated, a lot of bulls are basically saying we're going back to all-time high, the bond market doesn't really matter. And again, not many people pay attention to the bond market because it's not a very sexy thing, right? Like the cost of money, the cost of capital is not really a sexy market. And a majority of retail investors don't really pay attention to the bond market. So I can kind of understand why you would have a lot of excitement about the stock market going back to all-time highs, because not many people pay attention to the bond market. But Anyway, that is the reason why it's very, very important to pay attention to. Now, also, I want to address something what I got sent yesterday, just in regards to the collapse of the United States dollar. Now, the thing is, I found this message quite funny, to be honest. And the reason why I found it quite funny is because they were basically saying that the US dollar is going to collapse and everybody's going to pile into stablecoins. Now, what many people don't really realize is that these stablecoin companies are the largest buyers of US Treasury bills. And like what I was saying over the past couple of weeks and months, I can imagine that they are going to be pushing through legislation for stablecoins because they are going to be one of the largest buyers of US Treasury bills, what ultimately reduces the yields and makes the bonds go up. So again, the collapse of the United States dollar, I don't think that is happening anytime soon. Again, I can kind of understand the logic behind it, but saying that everybody's going to go to stablecoins is probably a little bit naive, because stablecoins are backed 1-for-1 against the US dollar. And obviously, where do you think stablecoins actually come from? Now, again, we can kind of debate about are stablecoins backed 1-for-1, blah, 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 blah. But again, I just found it quite interesting about how people are currently assessing this event and the anticipation that people are just going to flock to stablecoins and away from the US dollar I think is a little bit naive, because again, there's still a significant amount of people who use the United States dollar. The dollar is not going to go away anytime soon. If the dollar does collapse, what do you think happens to the Canadian dollar or the British pound or the euro? I mean, it is going to probably be a little bit insane if that did actually happen. So anyway, hopefully this video has been informative. And yeah, I'm currently out walking. Now, this is what I do every single day, is I pretty much go on a walk, listen to books, listen to podcasts. I'll probably do a video on books and podcasts, just what I obviously listen to on a daily basis. But anyway, to the 4 people who keep on supporting me, hope you're having a lovely day. Take care. Bye-bye.